there's a lot of people out there that invest in real estate. And before, I was like a cash flow type of guy. Like I would strictly buy real estate for the cash flow. But the part that I didn't understand is that a huge benefit to buying real estate is the depreciation aspect of it. So what is depreciation? How is it calculated? And how does cost segregation fit in the depreciation aspect of it?
Yeah, absolutely. So depreciation sounds like a negative thing, right? Mm-hmm. But it's actually not. In tax terminology, depreciation is actually a borrowed term, okay? Because the concept of something going down in value doesn't actually really apply to real estate, because real estate is actually going up in value. It's appreciating. Nevertheless, the IRS gives you a tax deduction based on the concept that property or that things go down in value as time goes on. So it's based on that concept. But when you buy a property, the day that you buy that, the purchase price that you spend on that determines what your depreciation basis is. I mean, the amount that you can actually deduct. And the IRS literally allows you to tax write off the entire value of your property. So you just buy a building for $1 million, you're allowed to write the entire amount off, but not all at once, right? You can only write that off on the schedule that the IRS allows, which for commercial properties is 39 years. And for residential properties, which includes multifamily, even though it's commercial, it's considered residential, is 27 and a half years. So that means you can take that $1 million and write off a deduction from your income tax every single year, $30,000 every single year for 27 and a half years. That's what depreciation is, okay? And it's great. You don't have to do anything, and your property is going up in value, is cash flowing, and nevertheless, you get to just deduct from your income and pay less taxes based on depreciation.
So in other words, to like simplify it for the listener, let's say you make $100,000, your property makes $100,000 in net income.
Right.
That would mean you'd have to pay taxes on $100,000. Now, let's say you have $100,000 of depreciation. The $100,000 literally wipes out the $100,000 that you make. So in essence, it's a break even.
Yeah.
In other words, so essentially, you're breaking even on paper, but in reality, you're making $100,000 because of the regular depreciation. Now, the way that Yonah explained it, if it's $1 million, your purchase price, you divide that by 39 and a half years.
39 for commercial.
39. And that's the amount of depreciation that you get to take based on the IRS schedule. Now, with cost segregation, it's completely different.